Hello, welcome to the Professional Investor Podcast with me, Jonathan Bramall. The podcast where we go inside the mind of a UK-based professional investor and look at why amateur investors get it wrong by following the herd. In today's episode, we'll be looking at the importance of income for UK equities. We are joined once again by Chris Boxall. Chris is co-founder and portfolio manager at Fundamental Asset Management. He has over 25 years as a professional investor under his belt, having worked in New York as well as in the UK. Thank you once again, Chris, for joining us today.
Hi, good to be here as always on a sunny day. Looking forward to the summer when it arrives. Although we
Yeah,
haven't had much rain, and it's all looking more positive. Markets looking more positive. The UK market's looking more positive, which is great news.
absolutely. As we've had a lot of doom and gloom around one way or another, and more positive times are here at the moment, which has got to be celebrated and sort of remind people that it's not all negative out there, because I think some people got that in their minds, don't you think?
Yeah, absolutely. I'm particularly pleased. I know this is for a topic for another time, perhaps, but I'm really pleased with the performance of AIM portfolios, and our AIM portfolios have really come flying back recently, and it's vindicated our belief in many of the companies that have been trading strongly. But it's great to see that for our clients. It's wonderful to see them hopefully starting to enjoy some better returns, and hopefully it will continue for some time now.
Yeah, fantastic. I always think of the football adage, form is temporary, class is permanent, which I guess is applicable in this instance.
Yeah. Let's hope that applies because there have been some really good performances lately.
Excellent, thank you. So today we're going to be talking about uh, the importance of income for UK equities, and it's a topic which I think often gets overlooked, and wanted to get your take on the subject.
Yeah, look, the FTSE, the UK stock market, has been a lousy performer in terms of capital growth, and everybody looks at some charts and things and assumes that it's been sort of dire. But within that, if you look at the detail, actually, the UK market itself has generated quite a lot of dividend income, and I think that's often ignored. And people like income; it's real cash in their hands and it demonstrates that the businesses, the companies in which they're investing, are trading well, and to support ongoing and growing dividend payouts. So I don't think dividends can be ignored. A lot of companies have never paid them, but even some of the largest US tech groups are starting to pay dividends. When you've got excess cash and you don't know what to do with it. While share buybacks are generally the favored approach, dividends are also coming back into favor. And I also think that share buybacks in themselves are often poorly thought through by many companies. A lot of them are doing it, shall we say, to massage earnings and support their own management's own sort of selfish targets. But are they the right approach? And I do think sometimes that a good old dividend payment is the way to reward shareholders more evidently. And historically, it's always been a great way to reward shareholders. And a lot of people rely on income. They need income, which is good news. So don't disregard dividends. And that's, I think, especially relevant at the moment.
You mentioned the FTSE and being poor for growth, and obviously you mentioned that even US companies are starting to perhaps offer more dividends than recently. In terms of the UK and the US, uh, is it something that's very marked that you see that FTSE companies are more inclined to offer equities, or is that a more recent thing? Sorry, not
Yeah,
equities. I apologize. Dividends, of course.
Yeah, absolutely. And yeah, it has. The UK has always traditionally been a higher dividend payer. Typically, obviously, there are these are lower growth stocks mostly in the FTSE, notably the 100 index. Well-established businesses that are of generally well invested. Growth prospects are less, unfortunately, and they've had excess cash. They haven't concluded that it's been good to reinvest in the business and have therefore paid out their excess cash as dividends. So the UK 100 index, for example, was historically, well, until recently, yielding over 4%. The forward yield, I think, has dropped back to around 3% and a bit now. So previously, a lot of the 4% return, you're getting from the dividends, and you think about the compounding effect of that over time, has been quite attractive. And there are some companies in the FTSE yielding as high as 10%. I can mention one, M&G Group, yielding a 10% dividend yield. That's the dividend relative to its share price. That's pretty attractive. You could say, well, what's wrong with it? Well, there's maybe some, low growth aspects. It may have some issues, but notwithstanding that, a 10% yield could be perceived as paying you for that risk. And the FTSE 250 index, that's the mid-cap index of stocks, the dividend yield is even higher, over 4% dividend yield at the moment, forward yields. And you can pick up yields as high as 14% from companies in that mid-cap index, 14%.
You see.
Typically, there are a lot of closed-ended trusts and investment trusts which have been out of favor, where you've got wide discounts to the net asset value of the trust, and which have been paying out quite big dividends. So you can see that's quite compelling. Now, compared that to the US markets, where the dividend yield historically has been well under 2% over recently. That's the S&P, say, 500 index. So you can see there's a big differential between the two.
Fascinating. And you mentioned before about sometimes the increased risk that might be reflected with a dividend. In your experience, how often do you see let's say a high dividend and you think warning signs here, or is it just part of your due diligence, or are you less cynical when you see a particularly high dividend?
There are two aspects. There's the ability of the company to pay the dividend. So how reliable a payer is it?
Right.
And also whether it's been consistently growing the dividend. Now, in terms of the reliability, a lot of people look at what's called the dividend cover. That's the earnings relative to the dividend. So say the earnings per share were 4p and the dividend per share was 2 pence. Well, there's a cover of 2 times. So you could conclude, well, that company is covering its dividend by earnings to quite a comfortable degree. However, earnings are not all created equal, and given the love of adjustments that many executive management teams like to indulge us with, it's very important to go under the bonnet to really understand what's in those earnings and whether they really are real earnings. So we would always say it's better to look at the cash flow statements because that's what the dividend's been paid out of cash. So we like to focus on what is the free cash generation of the company and whether that free cash flow has been and is likely to continue to start growing. And typically we want to see free cash. That's all the cash the company generates each year over and above its ongoing capital investment requirements that it has available afterwards to support a dividend. So we would always like to see free cash covering the dividends. I mean, it's an interesting point at the moment because I saw a company yesterday. The free cash was decent. It's got a growing dividend, but it's also using a lot of its cash to support share buybacks to the extent that actually the reality is that it's increasing its debt to support some of these payments, which we don't like very much. And the company in question, I won't mention it, but it's been a decent performer. But that to me doesn't look right. Free cash should be used to support dividends. It shouldn't, and free cash should be used to support share buybacks. Companies shouldn't be lifting their debt, which has become increasingly costly to support either one of those two, either dividends or buybacks.
Thanks, Chris. That's fascinating. And in terms of you mentioned the importance of looking under the bonnet, doing due diligence and so forth. Uh, is there services that people can buy? Obviously, you're a provider of asset management services. Is it the sort of thing that you provide for clients to come and speak to you about, or how does it work?
Yeah, look, there are loads of income funds, but we would argue the problem with income funds is the cost of them. So you can buy into a fund that invests in higher income paying stocks, but the problem is they come with a lot of costs. And the last thing you want with income and relatively modest growth is too much costs. So we run a dedicated income focused portfolio where the costs are relatively modest. There are no audit fees on it, administration fees on it, custodian fees, and all sorts of other ancillary fees linked to it. So it's a low cost route to income investing, and its focus is on larger, so mid cap and above UK dividend paying stocks. We don't run an equity income portfolio for our investor base, investing in US stocks, because there are complicated also withholding tax rules around that. And you also have the foreign currency aspect of it. So in terms of income, we like to stick to UK dividend focused companies. And dividends, I said they're a great part of investing, particularly where interest rates are declining. I mean, we're looking to have a declining interest rate environment. So if you've got a company, if interest rates start falling back below 4%, and you've got a company yielding 5, 6%, it's looking even more attractive. And if those companies in question have got debt as well, their debt's going to become cheaper, and conceivably that will give them more leeway to up their dividends. So paying a good dividend, a growing dividend, is a great sort of way to highlight that we believe the financial security of a business. And it's a great discipline to follow, for companies to follow. So making it an attractive investment proposition.
Thank you. And in terms of the service you offer, then, not a fund, but a direct equities portfolio service, how many stocks typically would you purchase on behalf of a client, or does it depend on the investment amount?
We typically run a fixed book of stocks, which broadly about 20, 25, well, 20, if it's a large portfolio, 25 stocks. So 20 equally weighted dividend paying companies. The forecast dividend yield at the moment is, I think, around about 5, 6% even. So it's a bit high. Oh, actually, no, it's touching more than that. It's just under 7, I think. Now we've had a reasonable return lately, and one of the companies been taken over. So it's a nice balanced portfolio across sectors and industries.
Fascinating. So you're it's across industry. Are there any areas in particular that you either gravitate towards or indeed move away from?
It's we very much, the portfolio has been sort of restructured lately because we see a little bit of an opportunity for a higher concentration in closed-ended investment companies, investment trusts. For some of these are trading on quite wide discounts to net asset value. So the share price is at a meaningful, that's 10% plus discount to actually the net asset value, or the value of its assets less its liabilities. And that's quite, in our view, when you've got a nice dividend as well, that's quite a decent place to start. And it's been very much an unloved sector. And we can see there'll be a sort of growing interest. An example of that, I can mention one recently, a stock called a healthcare REIT called Assura, which owns more than 600 healthcare properties, doctors, surgeries, private hospitals, etc., has risen in price recently after it received a bid from giant US private equity group. They've looked to offer simply the net asset value. So you've had an immediate closing of that gap between the net asset value and its share price, and you've had a business that's been yielding 7% plus. That's quite a decent return. So yeah, the portfolio itself has got a decent mix, but lately we've got a higher concentration of closed-ended investment companies. Another example is the supermarket income REIT. As the name suggests, it holds investments in properties leased out to the UK's largest supermarket groups. Its portfolio is sort of 80 plus stores, valued at about 1.8 billion, something like that. And this doesn't generate the most exciting returns. However, it does generate a consistent dividend.
Mm.
The dividend yield is about 8%. And again, it's trading at a circa 10%, a little bit more discount to the net asset value. The share price is a discount to the net asset value. So you've got a bit of protection there. And it's a type of business with lots of reliable blue chip tenants who are also happy to accept a small increase in their rents, which of course knocks on to a small increase in the dividend payout as things go forward. They're also it's a business that's looking to save some costs again, so that can all go towards shareholders, towards a more elevated dividend payout. So you get the sense of it. That's a couple of examples of some of the closed-ended investment companies we're looking for.
Fantastic. I appreciate that, Chris, and thank you very much for joining us today and for discussing this often overlooked area of investment and explain to our listeners the importance of dividends and looking beyond simply capital growth. And it's
Yeah,
also sorry, carry
yeah.
on, please.
No, far away. Sorry, I
No,
didn't
no,
want to
it's and
jump
it's
in.
no, it's great also to hear things are looking more positive generally across the board.
Yeah, no, it has been good. I think circling back, I think high dividend yields are a factor of things getting more positive as well. If people see that there's 8% to be had, or 10%, or 60% to be had in a dividend, and a company has seemingly increased it, well, that's a driver of share price performance. People think, well, I'm going to buy those shares. Well, so you're going to get the shares will keep going up, and you're going to get your dividend as well. And UK stocks have been so unloved and have looked such good value by many measures for such a long time that it's about time really that things are starting to improve, and thankfully they have been.
Fantastic. Well, it's great to hear, and thank you very much for your time today, Chris.
Pleasure.
It's great to have Chris give his experience on the podcast as ever. If you want more information about the fundamental UK dividend income portfolio that Chris was talking about, you can find it on the Fundamental Asset Management website, fundamentalasset.com. That's fundamentalasset.com. Please consider liking and subscribing to the podcast, and thanks very much for listening to the Professional Investor Podcast today.